All right. Today is Sunday, May 7th, and this is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. Welcome to the Big Sunday Show. Now, let's just recap what happened over the weekend. Anything important here? I don't know if you watched the Kentucky Derby or not, because the horses were dropping like flies before the race, with all of the steroids, all the cruelty for what? To entertain a bunch of rich assholes with funny hats? And speaking of rich assholes with funny hats, the United Kingdom now has a new king, and his name is King Charles. And I'll give His Majesty about, 3 years tops, and then we need a new king. I mean, the guy's 74, but he's a rough 74. With that being said, if he runs for president here in the US, it'd be considered a kid. 74 years old, that's a baby. Anyhow, folks, we have to move on here and get down to business because we have a lot to talk about. I'd like to separate this show into 3 segments. Number 1, let's talk about the Fed policy, then let's talk about the macro data, and then what's going on in the market right now. And after we do all of this, we're going to tie it all together. So let's start with the Fed. We begin with what else? Inflation. And this is for future central bankers, in 2050, 2060, if you're watching YouTube at that time. I don't know if it's going to exist or not. But in order to avoid all of the problems and the mistakes that the geniuses we have today have committed, you have to understand the process of inflation. Inflation has many stages, but the main ones, in the beginning, everybody denies that we have inflation. Oh, we have inflation because of supply chain problems, because of the thing, because of the war, because somebody fought it and blew up a factory, whatever. They blame it on something silly, dismissing and denying the inflation problem, when we all know that the core reason why we have inflation in the economy is the monetary policy. Always been this way. When the Fed goes crazy, printing money out of thin air, trillions and trillions of dollars to stimulate an economy that doesn't really need any stimulation, well, the end result is inflation. What comes after the denial stage is the honeymoon stage. Sure, prices are moving higher, but wages in the economy are also moving higher. And we see corporate profits getting fatter, and we see the consumer handling all of that pretty good, because at this stage, the growth in wages still exceeds the growth in inflation. But then, the growth in prices surpasses the growth in wages, and we got a problem. Inflation shows its ugly side. It starts to surpass the growth in wages, and folks have to dip into their savings and credit card debt to cope with this inflation. And little by little, we move into the systemic risk stage, meaning at this stage, inflation has done so much damage to the economy that if the Fed raises rates at this point, there's a high probability of something blowing up. And of course, the most dangerous stage of this inflationary process is when we start to see rapid and increasing job losses in the economy. Now, the trick here is to avoid all of these problems that we're in right now is for central bankers to start raising and normalizing the monetary policy in the honeymoon stage. Unfortunately, our genius central bankers, during the honeymoon stage, they kept saying, oh, it's transitory. They never moved on from the denial stage, and they started raising rates a little too late, and calling it a little is generous. And now we are at the point when the Fed raises rates, the probability of systemic risk increases because the economy is more fragile than it was back in the honeymoon stage. The consumer is a lot weaker, debt has accumulated, corporate margins are getting worse. So what is the remedy here? Does the Fed have to stop to avoid systemic risk in the economy? This is the number one debate that's going on in Wall Street, in the economy, in the media. Should the Fed stop? Because we have a bunch of banks blowing up. Well, that depends on inflation, isn't it? If inflation is trending down and it's closer to the 2% target, then sure, the Fed should stop right now to avoid more damage to the economy. Mission accomplished. Inflation is down closer to the 2% target, and there is no need to harm the economy anymore. And the moment the Fed pauses and stops and maybe starts reversing its monetary tightening policy, the economy moves back into what it's called a soft landing. The inflation problem has been defeated without producing any systemic risk and any higher unemployment in the economy. And it appears for now that a lot of folks are actually believing this. They believe, okay, the Fed has done enough, inflation is dead, it's going down to 2%, and there is no need to increase rates anymore and cause more systemic risk or unemployment that the economy doesn't really need and cannot really afford. Mission accomplished, Fed. This is what the soft landing theory is all about. It's not just market participants who believe in that. Now, even the Fed believes in this crap. You heard Jerome Powell in the conference this week. He said that he believes in the soft landing theory. That is his base case. And now we got on Friday St. Louis Fed President James Bullard, who said that the U.S. Central Bank can still achieve a soft landing with inflation coming down without triggering a significant downturn. Does it sound too good to be true? Because it is. And now the talk in the Fed is, we don't need to raise rates in June. Let's just pause and see what happens. And Bullard, of course, supports that now. And this rat, this new imbecile Goolsbee, who just infiltrated the Fed, he was actually a hire by Wall Street, by the banksters, to infiltrate the Fed and convince Jerome Powell to back off. He also supports that. Let's see what history tells us about inflation when it rises significantly higher, as we have in this episode. What will it take for inflation to go down? We're talking for real, not just a dip and then it comes back. What will it take to finally break the back of inflation? We go back to the case of the late 70s, early 80s, aka the Volcker case. This might be confusing to you, but rest assured, there is one point that you need to understand. But we have the CPI in white, we have the federal funds rate in red, then we got the SPX, the stock market in green, and the unemployment rate in orange. In the Volcker case, inflation was surging higher, but inflation peaked before the federal funds rate and before the stock market. And then the last to peak is the unemployment rate, as you can see in orange. What do we learn from this case? Inflation was surging higher, and then came Chairman Volcker. He raised rates significantly higher. Inflation dipped down. And the banksters at the time, of course, added a lot of pressure on Chairman Volcker to back off. He backed off, inflation rebounded. Then he said, okay, fools, step out of the way. Let me do the job. And he raised rates again, as you can see in red. And inflation did respond. It went down, but it wasn't broken. There was no guarantee at the time at around 80, 81 that the inflation episode is over. And then came the rise in the unemployment rate. And that is death to inflation. The moment the unemployment rate rises higher, significantly so, say goodbye to inflation. It's over. In case number 2, we have the late 80s, early 90s, which stock market bulls love to look at. This is the Russian ruble crisis, the tequila crisis, in and around that time. In this case, we see the federal funds rate peaking first, and then comes the CPI peaking later, and after that, the unemployment rate. But during all of this process, the S&P 500 never crashed. It went down a little bit during the Gulf War, but that's about it. What can we learn from this case? The stock market aside, one would argue that, look, the Fed learned from the 70s, 80s, and the moment they saw the CPI moving higher, they moved right away, raising the funds rate higher. Some would argue that it was actually an overreaction, and therefore we didn't see the stock market crashing, although the end result of raising rates significantly higher was a surge in the unemployment rate. And the moment we saw the unemployment rate surging higher, that was the end of that inflation episode. Goodbye. So stock market aside, what can we learn from this episode? Number 1, when the Fed raises rates significantly higher, all of a sudden, sooner or later, we're going to see the unemployment rate moving higher. And the moment the unemployment rate surges higher, inflation breaks. And again, for the bulls, we're going to say, hey, Maverick, but what about the stock market in the 90s? It didn't crash. Maybe we're not going to crash this time around. Look at the move in inflation from the late 80s to the early 90s. It wasn't even that significant, but the Fed was really vicious at the time because they learned the lesson from the late 70s, early 80s. They were traumatized by it. The moment they saw inflation going higher, they were quick to act. Now, what can we learn from case number 3? This is the 2000s, the GFC. What do we see here? Inflation started to move higher, as you can see in white. The Fed raised rates significantly higher, as you can see in red. And then they paused at around 06, 07, and they held that rate. As they were holding the rate, inflation moved down, but also the stock market moved down. We started to see a lot of systemic risk in the housing market, in the banking sector. So the Fed said, okay, we're going to start cutting rates now. The result of that is the CPI actually moved higher. It rebounded higher, as you can see in white. But because of the delay that happens between the line in red and the line in orange, as you can see, every single time the Fed raises the fund rate significantly higher, sooner or later, unemployment will surge higher. And the moment unemployment surged higher, the stock market broke, and with it, inflation broke down too. What can we learn from this case? The answer is the same. When the Fed raises rates significantly higher, sooner or later, we see unemployment rising higher in the economy. And to break inflation, the key is to spike the unemployment rate significantly higher. This was the case in the 80s, 90s, 2000s. What do we have today? You got the stock market in green. You can argue that this was the top in 22. Then you got the CPI in white. We can argue whether this is the top for the CPI or not. But what we know for now is the federal funds rate has not peaked yet and the unemployment rate did not move higher. In other words, assuming that this is the peak for the CPI is mistaken, because without a significant rise in the unemployment rate, there is no guarantee this will be the end of the CPI. The CPI could rebound higher again, as we've seen in prior cases. And if that is the case, have we really seen the end of Fed rate hikes, as you can see in red? And most importantly, have we seen the bottom in the S&P 500 in green? All of these are good questions with no answers for now. But what we know, historically speaking, is the Fed has to continue to raise rates higher and higher and higher until they start to see the unemployment rate in the economy moving higher. That is the moment when they have to stop, because the rise in the unemployment rate will do the job for them and crush inflation down. Right now, we are not there yet. Keyword yet. And the question becomes, how high would the Fed funds rate has to go before we see the unemployment rate responding? For now, we went significantly higher in a short amount of time, yet the unemployment rate is not responding. And see, this is where the debate begins. The bulls, the doves, they look at this and they say, this is different. It is different this time around. And Jerome Powell, the imbecile that he is, he said that in the FOMC. He said it is different this time, which means we can stop right now. We can pause. Inflation will continue to go down. And oh, by the way, the unemployment rate is not going to move higher. The problem is we have no precedent for that. So Jerome Powell says it is different this time around. On the other side, observers like me, for example, we say the job is not done. The CPI is going to rebound higher again, and the Fed must continue to raise rates significantly higher until they start to see the unemployment rate moving higher. That is the moment when they stop and they start cutting, because the unemployment rate will do the job for them. The problem is, in prior episodes, it didn't take too much for the Fed to start to see a reaction in the unemployment market. They raise rates significantly higher in a short amount of time, and then usually the unemployment rate starts to rise in response to that quickly. Not this time around. It appears that the unemployment rate is too stubborn, and it's going to take the Fed to do more. Pay attention now. It's going to take the Fed to do more to elicit a reaction from the unemployment rate. And if you just understood what I said, you know that this is really terrifying, because it means that the rate will have to go a lot higher. We'll take it one step at a time. What did we get on Friday? We got the employment report, and the headline says 253,000 jobs created. The unemployment rate falls. Now, with that being said, we got a lot of revisions from the BLS, aka the kitchen. For example, they revised prior reports from 236,000 jobs to 165,000 jobs. That's a lot. That's a huge miss. So either they're lying and the unemployment rate is actually moving higher, as we talked in a prior video, or if we take this at face value, it means that the Fed will have to do a lot more than we previously thought. Once again, one step at a time. The number one sector with the most jobs created in the month of April was education and health, with about 77,000 jobs. Then we got business services at around 43,000 jobs, leisure and hospitality with about 31,000 jobs, and then we got government, 23,000 jobs, construction, 15,000 jobs, manufacturing, 11,000, retail, 7,700 jobs. And while the pace of job creation has slowed down, it's actually not job creation, it's job recovery, at least in leisure and hospitality. But anyways, you can see that the pace slowed down, and they say, oh, the labor market remains resilient. Here it is again. Yet the good news from this report is prime age participation in the workforce is increasing. When we look at 24 to 54, we're now above the pre-thing level. So we have a recovery here. Here's the problem. For the soft landing theory to hold, you need to see job creation, but not inflation. This is not what we're seeing. Matter of fact, average hourly earnings posted the strongest monthly advance in a year. Wage growth, continues to move higher. Now, Powell said, maybe wage growth is a reason for inflation. Maybe not. I don't know. I don't know what I'm talking about. I had a few, he said. And again, the summary from all of this FOMC that we got this week is, if you understand anything about economics, you know that the pivot door is closed. They're not going to pivot. They're not going to stop until the unemployment rate moves higher or something blows up as a systemic risk. So when people say, oh, the Fed is going to do this, is going to do that, they're going to pause, they're not going to pause, who cares what the Fed says? The Fed is a monkey dancing on the tune of inflation. The Fed is not in charge. Inflation is. If the CPI next week comes out higher, they're gonna have to hike again. End of the story. So the pivot door is now shut, but the soft landing door is not yet. And that keeps the market going higher. Because so long as the soft landing door is open, we can play with that. We can say even Powell said this time it's gonna be different. That sure, we're not gonna see a rise in the unemployment rate at all. And the inflation rate will go down to 2% on its own. Boom, mission accomplished. But if you happen to be rational and you see this as a really concerning sign that jobs are sticky this time around, not just inflation. And to end the sticky inflation, we need to resolve the sticky jobs market. And to do that, we need to add more and more pressure, which means rates will have to go significantly higher than we previously thought. And that's really scary. I know I'm the only one seeing this right now, and I hope I'm wrong, but I have good reasoning that I'm not going to be. We look at the New York Fed survey of consumer expectations, and we ask employees, what are the chances of you losing a job over the next year? Most people right now are comfortable. I'm not going to lose my job. There is a labor shortage. My employer needs me. They're never going to let me go. And this kind of thinking fuels more and more inflationary expectations. Because if you have your job in the bag, what is the harm of you going out there and using your credit card? You're going to pay it later on. You get your salary, you got your job. You can keep with these prices going higher. You can keep swiping those credit cards up and down, up and down, up and down. Because you got your job in the bag. And when we talk about the stickiness of the jobs market, now that the Fed stimulated excess demand in the economy by printing money out of thin air, trillions and trillions of dollars, and you can argue that the thing also combined with the Fed is contributing to this, we have severe job shortages. Look no further, for example, than the airlines industry, be it the shortage in pilots or the shortage in air traffic controllers. Take a look.
Growing concerns over pilot shortages heading into the busy summer travel season. Tom Costello shares what you can do to stay ahead of the travel chaos.
Countdown to the summer getaway, and don't expect an open middle seat. It's shaping up to be another season of crowded airports and packed planes.
Good morning, how you doing?
The head of the TSA tells Bloomberg the agency is preparing for a record number of air passengers throughout the summer, comfortably above pre-pandemic numbers. With airports in Orlando, Dallas, Houston, and East Coast hubs all expected to be the busiest. With demand surging, American Airlines is joining Delta and United in temporarily cutting back some flights into New York airports, citing air traffic controller shortages.
There's a need for more air traffic controllers. They are responsible for guiding planes from a tower during their flights and making sure they are properly separated from other planes that may be in the air at the same time. Some of the basic requirements to apply for the job include being a U.S. citizen, younger than 31 years old at the time the application window closes, and having either 3 years of general work experience, 4 years of education leading up to a bachelor's degree, or a combination of both. The lack of air traffic controllers is causing some major airlines to cut their schedule this summer. American Airlines plans to trim its service in New York because of the low numbers of air traffic controllers in that region. Because of that, delays could jump by 45%. United and Delta Airlines have also asked the FAA to be allowed to cut up to 10% of their flights. Right now, airlines are flying about 10% fewer flights compared to before the pandemic. The union that represents air traffic controllers says staffing levels have been dropping over the last decade.
Now, let me ask you a question here. If we have a shortage in pilots and we have a shortage in air traffic controllers, we are heading to the hottest travel season and demand doesn't appear to be slowing down. What would these airline companies do? They have to hire right now at any cost, and this means wage inflation. They're desperate for pilots. They're desperate for air traffic controllers. They have to pay them higher wages. Otherwise, they're going to have a severe shortage this summer season. Now, if you're the Fed, you look at this. If you're rational, and we know that Jerome Powell is not, this should be alarming to you, that wage inflation will continue to move higher. If the airline company is now paying pilots more, if the airports and the FAA paying air traffic controllers more. They're going to have to charge us more. They're going to have to pass all of this inflation in wages all the way down to us consumers. So if you happen to be the chairman of the Fed, you got two choices. Let it be. Say, okay, I'm going to pause now because the inflation rate went down from 9 to 5. And that's victory in my book. You will end up watching the CPI revving higher again and perhaps making a new high. Or the other choice is, well, the jobs market is not helping me a lot right now. And whatever we've done with interest rates, it's not impacting the jobs market negatively. And I need the unemployment rate to move higher to tackle the CPI down once and for all. So what do? I'm going to have to raise rates higher and higher and higher and higher until I finally see this jobs market breaking. And maybe this rate will be, 6%, 7%, 8%, who knows, until we get a response from the employment market. And folks, again, while some people see this as a possibility of a soft landing, I see this as extremely terrifying. And if you think that inflation is over, the mania is done, look no further than the token Pepe. This is yet another tulip with a market cap that is now above $1.2 billion. And this shit token, the valuation of this one, briefly surpassed the market caps of regional banks. Matter of fact, the entire regional bank ETF. Tell me again that the inflation process is over. You got to be a fool to believe that. And now let's talk about macro and try to tie it all up. In part number 2, here it is. Whether we're talking about an economy in inflation or recession or stagflation, we have to look at the 4 main pillars of the economy: manufacturing, services, jobs, and housing. We can argue about retail, but I'll tell you why I'm not using that. The majority of data we get about the consumer spending that is, they use a numerical number. Oh, this month consumers spent about $2 billion. Next month they spent about $5 billion. And we can look at this and say, oh, the consumer is healthy and strong and they continue to spend. Well, what if they're paying higher prices? You're not going to be able to distinguish between which one is what. So we're going to limit the conversation about manufacturing, services, jobs, and housing. We start with manufacturing. Manufacturing, I would argue, is in a recession right now, but moving away from recession all the way back to either stagflation or inflation altogether. What am I looking at? Look at the manufacturing PMI. Now it's back above 50 again by a tick. Almost at 50. Below 50, it's recession. Above 50, expansion. So we know manufacturing is moving away from being recessionary. But here's the problem. In the PMI, they say despite subdued customer orders and another drop in input buying, suppliers hiked their prices at a steeper rate. Cost burdens rose at the sharpest pace for 3 months, as selling prices also increased at an accelerated rate. Higher supply prices came despite reports of greater stability in supply chains and a survey record since May 2007. So I would say that manufacturing is moving from recession to stagflation because prices are moving higher, not so much when it comes to the pace of economic activity in manufacturing. What about services? I would argue it's moving away from inflation closer to stagflation, where the pace of activities and services slowing down, yet prices sticking. What am I basing this assumption on? Here it is. When we look at core services, for example, in the PCE inflation or CPI, they're moving higher. And then when we look at the services PMI, the rating is above 50, so we know it's expansionary for now, but it is slowing down. It's kind of stalling here and turning a little bit to the downside. But what about prices? Here it is. Concurrently, inflationary pressures regained momentum. Service sector input cost rose at the steepest rate for 3 months, while the increase in selling prices quickened to the fastest since August 22. So we have manufacturing and services moving towards stagflation. This should be alarming. Then we got jobs. We just talked about jobs. That's inflationary. Wage inflation is moving higher, and the pace of job creation continues to move higher too. Now, what about housing? Unfortunately, a lot of, misinformed individuals. They say that housing is in a recession. That's baloney. Housing was never in a recession. All what happened to housing is 2 things. Number 1, we ran out of supply. Good luck finding a decent single-family home at a decent price in any desirable city or neighborhood. Number 2, rates moved higher, and with that came the rise in mortgage rates. And all what consumers are doing right now is taking a step back. They still have the money to buy the house, but they're waiting for a better opportunity. The thinking goes, the Fed is raising rates right now, but we know that the Fed has no credibility. At some point, they're going to cut rates. So why would I get my mortgage right now at these steep rates when the rate is about to fall months from now or next year, for example? We have seen repeatedly this year, the moment mortgage rates went down, we saw an acceleration of the aggregate demand in buying and applying for these mortgages. And the most important indicator I look for is rent prices for single-family homes. Because if you want to buy a home, but the mortgage rate is too much and prices are too steep because the supply is not here, and maybe you're waiting for a better supply-demand dynamic at some point, or maybe better mortgage rates, what are you doing right now? You're renting single-family homes. So we have to look at the hottest markets in America, the ones that led housing inflation, and see what's going on with rent prices for single-family homes. In the city of Phoenix, the trend this year, 23, way above the trend from last year. Inflation is revving significantly higher in single-family homes rentals in the city of Phoenix. Another one, what about the city of Orlando? This year, the trend is higher than last year when it comes to single-family homes rentals. How about the city of Las Vegas? Also higher than last year. When we look at the city of San Diego, here it is. Single-family home rents are moving higher again. In a nutshell, the aggregate demand in housing never went away. And you have to be a chump to believe that housing was in a recession or is in a recession. It's not. It is just a case of lack of supply and higher mortgage rates for now. Look at the stocks of D.R. Horton, for example, Lennar. All of them are pretty much at all-time highs. This doesn't say housing recession at all. It actually indicates higher inflation in the housing market. So that's that. Now, let's tie it up when it comes to the market. This is part number 3. We talked about the different camps. The bulls have 2 camps. The bears have 2 camps. The bulls have the soft landing, and then they have the pivot. And the bears have stagflation and the recession team. And of course, when it comes to team pivot, I added Professor McCulley, aka Kinder and Janneler, along with a good professor from Wharton, both corporate hacks, of course, both corporate economists. And here's a reminder for you of what the pivot theory is, according to Professor Kinder and Janneler. Take a look.
Have an inflection point. I hesitate to use the word pivot because I'm not sure what it means anymore, but I think we are approaching an inflection point where we're going to have kinder, gentler monetary policy moving forward. Yes, it's a moment of kinder, gentler monetary policy to come, and I think the marketplace is having a small party. Core CPI, core PCE, but particularly core CPI, is by definition, by architectural design, a lagging indicator, particularly on the housing side of things. And the housing market has cried uncle. When you look around the nation, it is unambiguously clear that the housing market is crying uncle, but that's not going to show up in the core CPI until 6 to 12 months from now. So I think we're at a point where the Fed could and probably will stop pounding the table so hard that it has to see core CPI cry uncle before he can move to kinder, gentler.
Paul, Austin Goolsbee spoke at NABE a couple days ago, and he argued that he doesn't think the Fed's going to change the target to 3, but there's a strong possibility that it de facto accepts 3 as an acceptable target and maybe can declare victory from there. You think that's going too far?
No, I don't. In fact, I would be a loud amen to what Austin was saying.
So this team is delusional. They believe that inflation is already done. I mean, 6 months ago, he said that inflation is lagging. And in 6 months, you see that rents and housing prices are normalizing. We're now 6 months since then, and housing prices continue to go higher. But the weaseling aside, the pivot theory comes down to what he just admitted. We don't care about inflation. We don't care. Up the target to 3%, 4, 5, who cares? The Fed has to pivot right now, and we should not go back to the 2% target. Who cares about inflation? We know that's delusional. The Fed is not going to do that, and if the Fed does pivot prematurely, it's going to be for the wrong reasons. And therefore, I say the pivot door is now shut. There is only one bullish door open, which is the soft landing. And therefore, Team Pivot is gone. Kaput. Goodbye. And the only team alive in the Bulls camp is the soft landing team. Now, when it comes to the Bears camp, I would say that Team Recession is dead for now. This week, they got exposed. That, yes, at some point, they're going to win. At some point, we're going to have a recession, but not right now. And that leaves a fight between Team Soft Landing and Team Stagflation. But that doesn't mean that Team Recession and Team Pivot did not do a lot of damage to the stock market, a lot of distortions, I should say, to the stock market. What am I talking about? Here it is. We know that we have different cycles in the stock market. We have expansion, inflation, recession, expansion, just like we got in 21, for example, where technology companies, cyclicals, retail, energy, industrials, pretty much everything goes higher. And then as the economy gets too hot and we start to see inflation in the economy, and the Fed raises rates to combat this inflation, you got to stick with energy, materials, staples, value companies, aka any company with pricing power, because they can withstand inflation, the ugly side of inflation, not the honeymoon. And of course, you got to go short high valuations, because when the Fed raises rates, all of these valuations will have to go down. And then we got the recession stage, in which you want to go long bonds, gold, silver, healthcare, the Japanese yen, and more specific sectors such as fast food, tobacco, alcohol. These tend to do pretty good in a recession, but you gotta go short oil and cyclicals. And folks, in reality, we are actually between inflation and a recession. We are right now in stagflation, and therefore I say Team Stagflation is the more mature one. We're watching a shit show going on right now. What are you talking about, Maverick? The distortions, baby. Team Soft Landing believes that we are now in a new bull market. We are in a new expansion cycle. It is absolutely delusional, but look at the distortion they've done in the stock market so far. Look at the AI mania. Look at stocks like Nvidia, for example. The shittiest meme stocks that has AI in them somehow. And then you look at the other team, the other extreme, Team Recession. Look at what they've done this week so far. They completely crushed oil for no good reason, and they stampeded in buying bonds prematurely. They stampeded in buying gold and silver prematurely, and I was kind of baffled on Thursday. Matter of fact, the title of my video was "Something Doesn't Add Up" when we talk about gold versus oil. Why is oil getting crushed and gold catching a bit while the dollar is not moving at all? Why did we see the WTI on Thursday crashing in the pre-market and then recovering? Somebody's lying here. Either it's oil or it's gold. And I said in the program that night that the old man gold seldom lies, but in this case, I'm going to say that gold is lying, oil is not. Matter of fact, energy is being punished with no justification at all. And comes Friday morning, we get the employment report. It's hot, hot, hot. And on top of that, we got China demand for oil matching the highs of the pre-thing. I'm like, this is lunacy to dump oil right now. And I told my viewers in Discord, I'm going to go and buy the dip in certain oil names, at least via call options to be safe. What do you know, on Friday, oil pops higher, gold dives down. In other words, the recession team jerked off prematurely, and they got exposed by the employment data. We are not in a recession yet. Now you got Team Soft Landing jerking off to the expansion theme and pushing these technology companies' valuations to extremes. What will be their wake-up call? The answer is, it could be this upcoming CPI. It could change the game 100%, or also known as 180. You see, if the CPI comes out hot and shows that we moved from 5% back to 5.5%, maybe closer to the 6 again, a month over month we see inflation revving higher, and we should see that because the only reason the last reading went down is energy prices. And since then, energy prices rebounded higher, and then they crashed again this month. But for the reading of last month, it should show that energy prices moved higher again. And that could be the nail in the coffin for the soft landing team. That sure, you can play this game all you want, but the Fed is not done. Inflation is not done. If inflation is moving higher, so will rates. And at some point, so will the unemployment rate. And there is not going to be a soft landing. In the meantime, until this battle is sorted out, what do we do here, Maverick? What do we do? It seems like a childish market where people are still debating a market that has a crisis of identity. I tell you what to do. If you happen to be an investor, understand that inflation is not over yet. It's going to take a lot more before breaking the back of inflation. In the meantime, you want to stick to the inflation playbook. You want to buy companies with the pricing power. And this earnings season, by the way, gave you many, many examples of companies raising prices and the consumer responding positively. I can name Chipotle, I can name PepsiCo, I can name Coca-Cola, I can name Mondelez, I can name many other names. And guess who've been telling you this since the year began? The rally in technology and the AI stupidity is the distraction. That's the red dress that you're distracted by. The real opportunity is in the names that are still enjoying the pricing power. I told you guys that I'm buying the dip in General Mills, GIS, in Conagra, CAG, in PepsiCo, in many other names, because they still have the pricing power. And the inflation problem is not over yet. And guess what? PepsiCo, all-time highs. Even Nvidia is not at all-time highs right now. General Mills, all-time highs. Conagra, not quite all-time highs, but it did recover significantly. These are companies with pricing power. These are the companies that you have to stick with as an investor until this inflation phenomenon is done. Now, what do you do as a trader? What do I do if I'm a trader, Maverick? I don't buy stocks, I don't hold them, I trade. What do I do because the market has been jittery? It did not move one way or the other for over a month now. What do I do? Number one, and this goes against my book, by the way. I should be here telling you got to trade the market every single day because I want you to watch my show. I want you to be active in my Discord. But I'm telling you, don't. You don't have to trade every single day. Only trade when the market spits out opportunities for you. And for about a month or so, the market hasn't been spitting anything at all. So why don't you go to the beach? Go to the backyard, play with the dogs, enjoy the sunshine. Bang your girlfriend, bang the neighbor's wife, do something besides sitting on the screen all day waiting for a trade. That's not going to happen. What you should be looking for instead is extremes. Extremes on the upside, extremes on the downside, and just trade those. Examples. You can use the RSI. You can use the MACD. You can use the Bollinger Bands. You can use whatever indicator you want to use, but don't use Joe Blow's indicator. Use something reliable with history. I gave you a few examples on Friday in the morning brief on Discord. I said, look, when we look at the Bollinger Bands, you got extreme cases that are due for a rebound. That is in LMT, Lockheed Martin, Valero, VLO, Amgen, AMGN. I think we also played Chevron, CVX. And then I gave you one extreme to the upside, meaning it's bearish on the Bollinger Band. That's Eli Lilly. What you got to do is look at these extremes. When you see something way oversold, due for a rebound, and then we get a green day, a tide that lifts all boats, you got to trade those. And then the extremes on the upside, aka the bearish ones, when we have ugly days in the stock market, when we have some sort of a fear, you trade those to the downside. And here are some of the examples that I provided. Daily chart for LMT Lockheed Martin. I gave you this in the morning on Friday. Lockheed closed up about 1%. Same goes with Valero, VLO. Extremely oversold in the Bollinger Bands. It caught a rebound of about 2.5% on Friday. Same goes with Amgen. Way oversold in the Bollinger Bands. It caught a nice rebound on Friday worth about 2%. Eli Lilly, that's way above the Bollinger Bands. It's going to pull back, but you gotta wait for an ugly day. And then you play this one to the downside. And that's it. You play the extremes. And then you sit back and you wait until a resolution happens. And the resolution might be this week. It didn't happen last week from the FOMC or Apple's earnings, but it could happen this week from the CPI. One way or the other. Either Team Soft Landing will be validated, and in that case, you're going to buy the RKKs of the world, all the shitty stocks that went down big. Or my team, Team Stagflation, will be validated, and Team Soft Landing will shed their pants. I'm going to see a massive sell-off in the stock market. That, oh my God, the Fed will have to do more now. Inflation's not over. And folks, perspective matters. When you hear all the rubbish talk about, oh, this is a bull market, we're jerking off to the moon. When you hear the bulls, of course, they're amateurs. They haven't traded markets for a long time. They get excited by any rally. Or you see pullbacks and then you see the amateur bears jerking off. This is going to be the beginning of the crash, yada yada. Perspective matters. Look at the monthly chart for the SPX. Nothing happened. We caught a little rebound in 23. That's it. And ladies and gentlemen, the stock market's job is to slaughter the amateurs on both sides. Last year, when the market was going down, it was easy for the bears, specifically the amateur bears, the Cubs. They buy put options on any rally, fade the rip. They score big. In this year, they've been getting slaughtered. They've been picking up on these rallies and failing over and over and over and over again. And by the time the market actually crashes, they have no more money to play. On the other hand, the Grizzlies, the big bears, guess what they did this year? In the beginning of the year, they actually covered a lot of shorts. They booked profits. And for the most part, they can take a stab here and there once in a while, trading options here and there, shorting some names here and there, but for the most part, when we talk about the Chainos of the world, when we talk about the Burrys of the world, they're sitting with massive piles of cash, and they're waiting for the deja vu of 09. And it's gonna happen, and they're gonna win at that point. Not the amateurs, though. And the same goes in the bullish camp. The amateur bulls, you can call them the Cops, they're gonna get slaughtered too, because they're jerking off to this little rebound. And when it turns sour, they lose all of their money too. But what are the big bulls, the professional bulls? What are they doing right now? You got the king of bulls, Warren Buffett, the big buffet. He's not buying right now. He's actually dumping billions of dollars of U.S. stocks. He's booking profits. He's raising cash for what? When the market crashes, he's going to pick all of these stocks at pennies in the dollar, just like he did back in 09. The market's job right now is to slaughter the amateurs. The message of the day is, doesn't matter to me, you're a bear or a bull, doesn't matter to me, but be a big bear, be a big bull, see the big picture. And the last point I'm going to make here, when we talked about shorts being important to the stock market in the latest video that I produced this week, Friday was a clear illustration of that. Guess who was doing the majority of buying on Friday? The shorts, the market maker. There are no buyers anymore. Without the shorts, the buyer of last resort, the KRE would be crashing right now like you've never seen before. But we got a nice short covering rally in the KRE on Friday. And of course, the geniuses at the media, they say, are banks the new meme stocks? Buddy, the shorts shorted the KRE. They covered on Friday. They took profits. That's it. No one wants to be short into a weekend is the mantra driving the bank rally. Amen. And not just the banks, by the way. It was Apple, it was Tesla, it was all of them. The shorts covered on Friday. Then they come back again after the CPI. They short, lather, rinse, repeat. And we talked about the KRE in this channel. I talked about it in Discord. I gave you this chart exactly right here. We're going to short the KRE if we have a break below 41.36. We got the break. Here comes the short. KRE goes down. And then on Thursday, I told you they're going to cover the shorts on the KRE because now we have talks about shorting ban. And we saw the unusual trade on the KRE. Somebody bought a significant amount of call options. These are the same shorts. When they short, when they're done shorting, how do they exit the trade? They buy call options. They get paid on the way down, they get paid on the way up. And absent of this conversation right now is, where are the legitimate buyers? Because right now, if you recall the video that I produced 2 weeks ago, a lot of you still don't understand what I'm talking about. You're still not going to understand what I'm talking about right now, until it's too late, of course. But we talked about a baseless rally. We talked about a rally based on the greater fool theory. I know the valuations are stupid. I know the AI mania is stupid. I know nothing makes sense. But I'm going to buy right now because I know there is a greater fool who's going to buy it from me at a higher price. And the question becomes, what if we ran out of buyers? What if everybody who wanted to buy the stock market, the dip, already did, and now they're stuck? And therefore the market is not moving at all. The only buyers left, the market maker and the shorts. What happens then? If there is no catalyst that's going to say to the people waiting on the sidelines, hey, you got to jump in, otherwise you're going to miss out. We have another leg coming in this rally. What if there is no catalyst that will attract buyers from the sidelines, new blood, to start buying at these prices right now? Then the only natural thing will happen is the holders will get frustrated and they will start selling. And that could be triggered by catalysts such as the CPI, for example, or it could be the debt ceiling. It doesn't matter what catalyst it is. All what matters is if we ran out of fools, if we ran out of buyers, and we only got the holders, the shorts, and the market maker, then the only destination we got left is down. The buyers become frustrated, they start selling, booking profits, the shorts pile in, the market maker sees all of these reverse gammas going on. You don't have to be a genius to figure out what's going to happen. And with that, folks, let's move on to the coverage of the stock market information. We begin with the closing of the indices on Friday. And here we go. On Friday, big rebound for the Dow, up by 546.64 points, or a gain of 1.65%. The Nasdaq leading the pack by 269.01 points, or a gain of 2.25%. The S&P in the green by 75.03 points, or a gain of 1.85%. When we look at the sectors on Friday, all positive, baby, but they're led by a massive rebound in energy. It got punished severely with no justification at all. So we got a nice rebound on Friday. You can argue it's short covering. We're going to see if that's the case, if we have a follow-up or not this coming week. Now, when we contrast the performance that we got on Friday with the week all in all, you can see that the picture is drastically different. The only three sectors trading in the green, technology, healthcare, utilities. I would say technology, thank you to Apple, but the leaders, healthcare and utilities, that tells you that the recession theme was the predominant theme for the week. And the confirmation is energy is the laggard by far. When we look at the breadth on Friday, NYSE 86% advancing versus 13% declining. The Nasdaq 73% advancing versus 24% declining. You know what this means. It means we have to go down to neutral, 50-50, in or around this ratio before the CPI. On to futures, commodities. On Friday, lighting up in the green, with exception of gold, silver, and in currencies, we have the yen. The yen was down for the day. Yet you have energy rebounding significantly higher, the WTI by more than 4%, the Brent almost at 4%. What is the conclusion here? It was the inverse of the recession theme. Now, the recession team would argue and say, but Friday was just short covering, and therefore we got the inverse of what we got throughout the week. If that is the case, then why did we get gold and silver down? Why would you take profits from these? I think the employment report was the light bulb that a lot of us needed. Wait a minute here, the recession is coming, but not right away. In the meantime, we have a stagflation problem in the economy, and therefore buyers flocked into commodities, buying oil, buying softs, buying grains, and as you can see, big gains on Friday. Moving on to the big casino, the options market, what do we see here on the action on Friday? Lots of volume showing up. We have options expiration, but folks, I want you to look at the IV rank. We're seeing zeros across the board. Tesla, Apple, AMD, Amazon, AMC, Microsoft, Coinbase, Shopify. And what this tells us is this is the lowest volatility in about a year for these names, meaning the premiums for options are really cheap, and they're usually cheap on the downside. What does that mean? If you own these stocks, it's a good time to start hedging for cheap. You buy insurance. If you want to short them, this is the time for you to build a position for the long run, September and beyond. But you have to buy incrementally because you don't want to catch a falling knife. You buy a big contract position and then let's say you're betting against Apple or Tesla and it rebounds by 5% in a day, and then it takes a while till it breaks, but you don't have any money to average down. So you got to buy incrementally. In any case, the hottest table by far on Friday was Tesla, the souffle, with around 2.7 million contracts traded that day. About 57% of those were calls. And at number 2, Apple, with around 2.3 million contracts traded on Friday. Now, we know that Apple reported earnings the previous day, so there was a lot of options activities in the name. The market maker was doing a lot of moves. Whether these moves are going to stick for the next week or not, we'll talk about that in the charts analysis. But we have about 2.3 million contracts traded for Apple on Friday. About 55.5% of those were calls. And at number 3, NVIDIA, with around 1 million contracts traded on Friday, about 60% of those were calls. Moving on to the unusual activities that took place in the options market on Friday. We start with the ticker GLD. This is the gold ETF. Now, is it a wrong time to buy gold, Maverick, if we're talking about stagflation? The answer is absolutely not. At some point, the recession is going to happen, be it organically by the Fed raising rates until the unemployment rate rises higher, or by something blowing up, aka a systemic risk. In either case, at some point, gold will be higher than it is right now. That doesn't mean it's not going to go 5% to the downside and then rebound higher. But if you're buying in the long run, then there is no wrong time to buy gold. And here we have a large trade, a big one. And it has 2 parts, calls and puts. The trader sold some puts, bought some calls. But we're going to read the GLD call one just to illustrate the sheer positioning in GLD. The trader or traders bought the 198 calls for the expiration date July 21st, with the expectations that the name will move higher and gain more than 5.5% by then. They paid around $3 a piece. Tenor, this trade, all in all, spending around $11 million. Now, you can read the put trade. The way I read it is somebody sold these puts. They raised about $1.50. They used that money to buy the calls for about $3 a piece. All in all, they reduced entry cost to about $1.50. You know the deal. But then we have a trade for XP, and if you happen to own the name, this is a really good trade to hedge. Let's say you own XP. You want some protection here, and you want it for free. The stock is now trading at around 15. Let's say you'd be good if the stock trades above 16. You'd be okay to sell your shares, but you're not going to be so happy if the stock crashes below 14 suddenly. So why don't you follow this trade right here? Somebody who owns XP sold covered calls, the $16 calls, for the expiration date June 16th, and they received about $1 a piece for those. They used that $1 and they bought insurance, aka protection. They bought the $14 puts for the same expiration date, and the whole hedging strategy is for free. If XP blasts above 7% by the end of the expiration date, they get rid of the position at a profit. And if the stock crashes down by more than 6%, they're covered. No losses. What's not to like here? And then we got the ticker COTY, Cody. I happen to own the name. It ran pretty good. I'd like to get rid of it. And I honestly wanted to swipe it with Estee Lauder, but thankfully I did not do that because that stock crashed by what? 18, 20%. But if you want to get rid of Cody, if you own Cody, you want to get rid of it, why don't you write some covered calls here? I did the same. I followed the exact trade right here. And I'm going to read it from my perspective because I own the stock. I sold the $13 calls for the expiration date June 16, with expectations that if Cody rises and gains more than 7.5% by the expiration date, I'm going to sell my shares for $13 a piece, which is good profit. And I received for these calls about 50 cents a piece. So if it happens that Cody moves above 13 by the expiration date, I sell him at profit and I keep the 50 cents a piece I pocketed. Last but not least, what about the SPY? Somebody's buying a lot of protection here. They bought the 386 puts for the expiration date July 21st with expectations the SPY could go down and lose more than 6.5% of its value by then. They paid about $5.25 a piece to enter this trade, all in all spending around $4 million. On to the heat map on Friday, short covering the tide that lifted all boats, no harm here, very few losers. You got Eli Lilly in pharmaceuticals, that ran way too high. It's due for a pullback. Same goes with Meta. We'll talk about Meta's chart in a minute. The gold miners are down for a reason. Booking.com, if you can see it in cyclicals, that's due to earnings. And you got Bud Light and consumer defensives. That has its own problems, shall we say. So let's contrast this with the weekly heat map, and what we see here is drastically different. Again, the closing on Friday was euphoric. And the amateur bulls are jerking off saying, hey, Maverick, look at this. It's a bull market. We're making new highs now. But it was the shorts, baby. It was the shorts buying. The rest of the week doesn't look pretty good. Energy down big. The banks are down big. A lot of technology names are down big. Adobe, Qualcomm, Micron, all down. Even in the big caps, Meta was down over 3% for the week. Some of the big cyclical names, Starbucks down big. Estee Lauder, all of these are warning signs about Chinese economy. But for now, nobody cares, right? It's all about the closing on Friday and what a handful of names did. That's all what matters. But here's perhaps another perspective for you. A weekly heat map for the ETFs. Flattish. Nothing happened. The big caps, if you look at large cap growth, that was actually flattish for the week. Value down, mid cap down, small caps flattish, be it to the downside. Energy down, financials down, technology all in all, barely in the green. XBI, the winner again because of a handful of names. And then you got GDX Gold. That's about it. Nothing happened this week. So let's do some charts and then wrap it up. And we begin with SPY, the S&P 500 30 minutes chart. What do we see here? Notice if we look at the RSI, we're moving from extreme lows to extreme highs, aka oversold to overbought at a rapid pace. This is absolutely insane. With that being said, all in all, the trading remains within range. Support 405. I have the wrong label there. It says 410. That's actually 405. The resistance becomes 416. This is the larger range. But then we have a mid-range at around 410. We trade above, we can consider that as bullish. We trade below 410. We can consider that as bearish within a trading range. 405 to 16. Nothing changed. Nothing happened. You can say that this is a lower low, a higher high. You can play with these all you want. At the end of the day, it was short covering Friday. Nothing to see here. Here's the daily chart for the continuous contract, the E-mini. We closed above 4100. Within range again, 4100 support, 4180 resistance. But it counts that we closed above 4100. That's a win for the bulls. Is it a loss for the bears? Not really. It would be a loss if we have a closing above 4,200. But for now, the bears are alive because you got the RSI still in negative divergence. You got the MACD indicator still in negative momentum. We could see a downside break just as easily. CPI comes out ugly. Down we go, breaking 4,100, if not even 4,000. SPX, the cash index, similar story here. Closing above 4,100, it counts as a win for the bulls. But is it a loss for the bears? You can't really say that because we're still within range. The RSI is in negative divergence. The MACD is in negative momentum. I would say it was a good fight. The bears won earlier in the week. The bulls made a comeback by the end of the week, thanks to the shorts. And that's that. Nothing happened. When we look at the weekly chart for the SPX, the danger, of course, if this is a bearish consolidation pattern all in all since October. If it is, and you look at the RSI, a little bit of weakness there. And the weakness began the moment we got some volume showing up. I view that as concerning. The bulls have to start moving a little higher above this range, above 4,200 ASAP. Here's the monthly chart. And again, it is consolidation in a wedge pattern. The RSI is weakening a little bit. The MACD never crossed. It never gave us that bullish signal. So be careful what your assumptions are. All what we got so far is a bunch of short covering, a little bit of excitement because of AI, a little bit of excitement because of the recession theme. Believe it or not, certain stocks do pretty good in a recession, but that's about it. What about the Qs? 30 minutes chart, what do we see here? We got a closing above the range because the range was 316. That is support, resistance 321.5, with the mid-range being at around 318. So can you consider this as a win for the bulls? The answer is, technically speaking, it is. But perspective matters. We moved from one extreme to the other rapidly on the RSI, oversold to overbought right away. And if we clean up the chart a little bit, we're making a double top for now on a weaker RSI. So there is a risk that we could see a pullback here and we go back to the range like nothing happened again. It has been a pattern in the Qs. Every time we have one of these downtrends, the shorts make a little bit of money, then they cover and we see these big pops, gaps higher, and then we go down again. Now, all in all, it's a good process for the bulls because we're moving slightly higher. But you got to keep in mind, if this pattern holds, we're going to go down next week. And we go back within range. So what is the resolution here? We need inflation because this whole story began with inflation. We need Mr. Inflation to give us an update. And if the update is ugly, we could see an oversized reaction in this chart right here. Here's the daily chart for the continuous contract for the NASDAQ. What do we see? We got a rebound of 13,000 of support. So far, so good. Closing pretty much exactly at the resistance at around 13,300. It counts for the bulls that they closed above 13,000, but there is no break yet. The momentum indicators look a little better than the SPY. Sure, the RSI is in negative divergence and the MACD is in negative momentum, but I see the NASDAQ gaining some steam here, which means we could see a break above the consolidation range. Now, we need a catalyst for that. Could it be a milder CPI? That is a possibility. Could it be earnings? We're done with most earnings. Unless, of course, the people waiting on the sidelines say, okay, we've seen the majority of earnings. They're not really that bad. I think I'm comfortable here buying the Qs and the big cap technology stocks. If that is the case, we will see a break to the upside. And of course, the bulls would argue that this is an A, B, C pattern, which will take us all the way to 13,600. Now, when we look at the big picture, the NDX, the NASDAQ 100, a monthly chart, what do we see here? We know that even if the NASDAQ breaks higher, there is an important level. There is an important resistance here, which is the top of the August rally of last year. But look at the RSI. It is so weak. Why is it weak? There's no volume. And this tells me that if there is volume, if the volume shows up again, we're going to go down big. And here's something to bear in mind. If we magnify the RSI a little bit, and we go back to the 0203 bottom, as you can see in the aftermath of the crash of the dot-com, we got a rebound in the RSI. There was a rebound rally. It appeared that we're out of the woods. That was a trap. The actual bottom came years later. The same goes in the GFC. We got a crash in the RSI, then we got a rebound, and we thought this is it. The summer of 08 rally. Bear Stearns goes bust. The Fed comes to the rescue. Problem solved, right? Not so fast. The actual bottom came after a crash, and it came at around March 09. Are we seeing the same thing here? Is this rally a trap? And then the actual bottom comes later in 23 or maybe 24? Something to keep in mind. And mind you, these bear market rallies are huge. Look at the dot-com bear market rally. It produced almost a 40% plus rebound. In the 08 case, we got a rebound worth about 23%. In the case we got right now in the Qs, if we go all the way back to the August highs, that would be a rebound of about 30% plus. It is not out of the ordinary, so keep an eye. And the leading indicator would be the SMH, the CHIPS ETF. Here's the monthly chart. Again, it's looking weaker than the Qs. And if it doesn't cross in the MACD, if we see the RSI moving down, oh boy, buckle up. This is going to be a big one because it would be an ABC pattern back to the trend line at a minimum. And that means the Qs is going to snap to the downside too. IWM, an hourly chart. What do we see here? We talked about trading extremes. You look at the RSI. It gets way oversold in the hourly. You buy some call options, you catch a rebound, close them, same day, goodbye. If you're a trader, in, out, hello, goodbye. We talked about 168.90. The chart became way oversold. The KRE got some short covering. And we know that the KRE and regional banks are having a tremendous influence on the IWM. But we also talked about that the shorts will come back to the KRE. They cover, then they come back. Which means you gotta fade the rips in the IWM until the KRE stabilizes first. Dixie, 4 hours. What do we see here? It is important that the Dixie is holding on to the double bottom for now. It lost the positive divergence on the RSI, but it is possible that it can gain this really easily if the CPI comes out hot. And then we talk about, oh, the Fed will have to increase rates higher. See, when it comes to bonds, it's really tricky. A lot of you say, hey, what if the CPI comes higher, Maverick? And we know for sure that the Fed will do another 25 in the June meeting. You have no idea how the 10-year yield is going to react. Is it going to follow what the Fed will do and just pop higher? Or will it say, oh my God, the Fed raising rates at this stage, that's recessionary. And we see bond yields moving down. Now, when it comes to the dollar, it's a lot easier. If the Fed raises, we go higher. If the Fed doesn't raise, the dollar goes down. So I'd watch the dollar, not bond yields. Bond yields are going to be really confusing right now. And if we have a pop in the dollar index aftermath the CPI, then your boy, the old man gold, is not going to do pretty good. For now, it is holding at the support of 2,000. But we have negative divergence in the RSI. We have what it appears to be a negative crossing about to happen in the MACD. I'm keeping my bear flag for a reason. I don't trust this pop that we got recently. And I seldom say that about gold. And the same goes for SLV silver. I'm not back in. I'm waiting for either a break above 24 and a retest, or we need to go down to 21.57. But for now, I'm leaving it alone. Silver is outperforming gold. I would prefer silver over gold if we have a decent rebound. If the dollar goes down, we have a revival of the recession theme, I would definitely go with silver. And here it is, Brent oil, a daily chart. What do we see here? We got a massive rebound on Friday. Now the debate goes, was this just short covering Friday, and then we see oil going down the next day, or next week, I should say? Or was oil unfairly punished? If we're talking about gold moving down because we don't have a recession yet, the jobs market says it's stagflation, it's not a recession. If gold moves down, then we should see oil recovering. Monday will be a crucial day. A continuation of the buying that we saw on Friday means more ground to be made, meaning we have to continue to buy the dips in oil, at least for a little while, take some profits, and then see what happens. On the other hand, if we see a 180 on Monday and we see gold catching a bid, then we have a revival of the recession theme, and the bounce that we got on Friday was just a mere short covering rally. Here's the 2-year yield daily chart. What do we see here? Rebounding from the same trading range. Really frustrating, no break one way or the other. But for now, I'd leave the bond market alone. The volatility is too high, and it is unpredictable how the reaction will be one way or the other. Look at the TLT, a daily chart within range. Nothing new here, nothing to see. We did not get a break one way or the other. We're going to leave the bond market alone for the moment. The VIX 4 hours chart, what do we see here? We got the breakout from the cup and handle formation. It failed to gain 20 by the end of the week. That is a loss for the bears, a win for the bulls. But the bears can look at the positive divergence in the RSI. That remains intact for now. And that could be that the VIX went down due to a short covering on Friday, catches a bid from 17, it moves higher again, and let's say after the CPI makes it above 20 once and for all. Not buying VIX call options until the VIX gets 20 in the bag. For now, 20 is not in the bag. Apple, the big kahuna, an hourly chart. What do we see here? Big gap higher. You can say it's mechanically done due to the options market after earnings, yada yada. We have a bull flag consolidation pattern for now. And if we look at the RSI, there's a little bit of room to go higher here if we have more short covering and more buying on Monday. But be careful here, because if we zoom out to a 4 hours chart, we go back to the trend line that began since the beginning of the year. It appeared that the trend was broken, and for now it appears to be a bear trap, that if you assumed, hey, the trend line is broken, I'm going to short, you got a massive pie in the face on Friday. But when charts break these kind of trend lines, it usually happens for good, which means if you caught the rally in Apple on Friday and you bought it, you could be eating a massive pie in the face comes Monday. And we see the break happens either way by the end of next week. That is entirely possible, and therefore it is frustrating. I would leave Apple alone for now because it is a frustrating chart. Got a break to the downside, did not work out, and possibly the break to the upside, this gap higher, is not going to work either. You look at the weekly chart for Apple, look at the RSI, positive divergence. Is this bullish or bearish? The answer is bullish. A break above a sloping line of resistance with lower highs. Now the chart makes higher highs. Is this bullish or bearish? The answer is it is bullish. And if Apple is bullish, then the market is bullish. The problem is, what if it is a trap? You don't know that for now. And therefore, I say leave Apple alone. If you happen to be a bear, you want to short Apple, wait till we see a break below the sloping line of resistance. If you happen to be a bull, you can buy, but be careful of crossing below this trend line again. That will be a confirmation for a trap. You got to be really careful here. You look at the monthly chart for Apple, not a single red candle for the year, but the RSI is really weak. The chart is making almost higher highs now, almost at all-time highs again, but the RSI is not responding at all. What is the deal here? Look at the volume, way too weak. In other words, we have seen net inflows into Apple, mom and pops, institutionals, doesn't matter, but we have not seen sellers yet. Nobody's selling their apples yet. Did the report provide any justification, any reasoning to dump Apple? Maybe, in the eyes of some. Now, you have to understand this. The technicals are bullish. What about the psychology? A lot of money managers will look at this and say, you know what? We're sitting on good profits on Apple. It's almost back at the highs again. We've been waiting for about 2 years now to get back to even. I think I'm going to dump some apples here. And if that is the case, it doesn't matter what the chart says. The stock will go down. Tesla, an hourly chart, what do we see here? I talked about perhaps a possibility of a triple top followed by a bear flag. And if we see a break below 158.61, we got to go short. We did not see that on Friday. Tesla caught a short covering rally, just like the rest, and it closed above 167.5. So is this a bullish signal to buy Tesla? The answer is, it is complicated. If you believe it was a short covering rally, then the chart on the RSI is overbought. It could reverse. It could lose this support by Monday. And then we talk about 158.61 again. So we have to look at the daily chart and what it says here. The daily chart, there's a possibility again that this is a short covering rally and it goes down. But you look at the MACD, you look at the RSI, they're all positive, indicating that the likelihood is closing the gap at 180.59. Then you look at the weekly chart, which is more important than the daily, and that one is bearish. It says it doesn't matter what rebound we get, we're going to break to the downside. So for now, Tesla's a little tricky here. It could go either way in the short run, and with that, a lot of pies in the face. So I'd leave this one alone until we have a break one way or the other, above resistance or below support. Amazon, 4 hours chart, what do we see here? It is hugging the trend line of the channel, but in doing so, forming what it appears to be a bear flag pattern. If it fails to reclimb the channel, down we go to support number 1, which happens to be 101.15. After that comes 97. If we look at the weekly chart for Amazon, we have a wedge consolidation pattern. If you believe that the pattern will hold, then we go down to the lower end of the wedge consolidation pattern. That would be sub 100, and then we see what happens. But if we have a break above this consolidation pattern, that would be considered as a bullish breakout. Meta, a weekly chart. We talked about this weeks ago. Meta has a little bit of room to go higher. It went way higher than my expectations, but then we talked about 244.61. We get to 244.61, you got to short, but you're probably not going to short because you're too scared. But guess what happened? We got to the same number, we got a pullback, and I identified the trend line. We break below that, we go down to 230. We went all the way down from 244.61 to 230. That is a downside of over 6%. It was a good short trade. But I also said cover your shorts at 230. We got a rebound 230 on Friday. Now what happens? It appears that we're going to see more profit taking. If this continues and we see a break below 230, we could see a reacceleration, a FOMO in booking profits for those who did not do so in the aftermath of Meta's earnings. NVIDIA, an hourly chart, what do we see here? The answer is nothing to see. Support 274, resistance at around 289.46. Doesn't appear that we have a break one way or the other. Can we make it all the way to 289.46 and then form a double top and move down from that point on? That is possible. We got a lot of warning signs from Qualcomm, from Micron, from Broadcom, from ASML. All of them are saying, watch, even AMD, by the way, all of them are saying we have a slowdown in the chip industry. We have a problem with oversupply. For now, NVIDIA is just riding the AI optimism, being the exception, not the rule. Last but not least, Bitcoin tulips, a daily chart. What do we see here? Within range, we don't have a break one way or the other. I'll be a buyer if we have a closing above 31,000. I'll be a seller if we have a closing below 26,555. The chart right now leans a little bearish because you have a negative divergence to the RSI, but it's not conclusive yet. If we clean up the chart a little bit, we can see perhaps a beginning of a head and shoulder formation, but it's too premature to assume that. We need to see a little more. We need to see a loss of 28,000, for example, as support. Anyhow, moving on to the conclusion of this video, what do we have in the economic calendar this week? Monday, May 8th, we have wholesale inventories. Then we have the Fed Senior Loan Survey. This will be important. And of course, the clown from Chicago. I can't stand this guy. Goolsbee, he should not even be in the Fed. He's going to be opening his hole on Monday. Tuesday, the 9th, we have Governor Jefferson, and then we have New York Fed President Williams. Williams holds more weight than Goolsbee and the rest of them. So Williams will be really important to watch. Wednesday, May 10th, the most important day, we have the CPI, aka the CPI. Thursday, the 11th, we have the PPI, which is less important than the CPI, but we use it as a leading indicator. Then we have initial jobless claims, continuing jobless claims, along with Fed Governor Waller. Lastly, Friday, May 12th, we have the import price index, consumer sentiment, and then we have a bunch of Fed zombies speaking here. We have James Bullard and Jefferson together, tag teaming. Lots of things to look for this week. So buckle up, folks. But for now, this is all I got for you. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
You want to tell it to me?